live from Charleston, South Carolina, and Bedford, New York. It's David Balin and Stephen Whiting, and we're here with The Point. Today's title, Peace Through Straits, and the AI Boom Goes On. These things are happening at exactly the same time. Financial markets are generally looking through the energy shock that's been caused by the Iran war and the blockade of the Straits of Hormuz. But what's really remarkable is our earnings and the sustainability of this AI infrastructure boom, at least through the end of 2026 and potentially 2027. The earnings estimates for technology have been revised only upward over the course of the last 3 months, and now there's a 45% growth rate in semiconductors that are themselves expected to grow EPS by 91%. Now, one can look upon this as the development of a giant, facility that'll be depreciating rapidly, but the fact is that the profits that are being earned by the semiconductor companies and memory companies today will eventually transfer to the users of those facilities, the software companies and other producers of data and services tomorrow. And we'll talk about that. And we are concerned about the fact that ultimately a turnaround, if you will, or a reversal in the semiconductor profitability will be an issue for us to face in portfolios. So with all of that, we're going to be contrasting this incredible earnings boom, AI boom, and the energy shock at exactly the same time, and sort of parsing through how the world economy, even though vulnerable, is actually sort of surviving all the way through this. So with that, Stephen, let's move to the next slide and talk about exactly what's going right now and the sort of remarkable nature of why semiconductors have been able to just increase margins, increase earnings per share, and of course the memory companies as well, and why we are both thrilled by and concerned by that.
So if you take a look, we've had more than 2/3 of companies report. The gain is already, for the S&P 500, risen 10 percentage points above where the quarter ended. 25% gain. It'll be higher than that when all of the companies report, though we have had a lot of the big ones. And really what I would say is that coming into this year, we looked for a broadening in the economy, that many of the companies that suffered through the caution, the shock itself of tariffs last year, that they would be feeling relief. Well, that's been replaced by an energy shock. And there you can see there are many things that are going up. This year, we should expect the energy sector to have easily more than a 50% EPS gain. But through all of this, the thing that's really rising the most, you can see, is in that light blue line, with semis expected to have a 91% EPS gain. And that would be, for 19 companies, about 30% of all the earnings gain for the S&P 500. Of course, again, their customers, the Amazons and the Alphabets, they're still doing really well too on the cloud computing. So there is an AI boom going on. I think if you look at the next page, though, and you put this in some historical perspective, I actually want to go one page forward first, if you don't mind. This is what happens when we adjust the page order. There's that left picture. Put this in perspective and look at that light blue line, which shows CapEx and computing. Now, I could go back to 1960. They invented the mainframe. They invented the PC. Of course, those were leaps. But this is a third year of a high level of spending on data centers. And there you can see it on the right. Last quarter went up $94 billion for the year. This quarter up $70 billion per year. Nothing outgrows the economy. 7 times faster forever. It would be the economy. There'd be a data center on every street. So at some point, this will come down. But I think, David, you should probably speak to the beneficiaries, and that's probably on the prior page.
That's exactly right. We'll go back a page. But your point is exactly right, Stephen, that what is different about this technological revolution is the fact that this is the first technology that uses itself, where you can actually teach it to do repeated tasks that replace a lot of human research, right? A lot of human functions. And these tasks, as they get replaced, use an enormous amount of compute, which is why it's being built out. And secondly, as we've talked about in prior points, the adoption of this technology is the fastest in history by a factor of 20. We reached 100 million users of AI in 1 month. And of course, now we're up to more than half of the world's population. We're now seeing penetration rates well above 60% in almost all industries, from small to large, all across this country, and above 45% globally as well. So, with all of this, the demand for compute is actually exceeding the supply, which allows all of what Stephen to just talk about. But what we're going to see is a transition from the benefits and profitability of hardware, the physical chips, to the beneficiaries of software and of companies that do adoption. And this is not going to be a universal adoption. For example, even though all financial services companies will get the benefit of AI, those that learn how to use it are going to be able to actually make more profits. Those that don't will make less profits. And at the very same time, AI is going to create competitors, much like CIO Group is competing in wealth management, competitors that are more able to do more things more quickly at the exact same time. All of this is very good for an elastic capitalist economy like our own. And that's important. But what Stephen and I are concerned about is that the market is so dependent on the pinnacle of semiconductor strength and pricing that we think it could have a deleterious effect to portfolios during the transition period in 2027. Next slide.
When we start on the page for a second, so David, one of the things that we had mentioned that you brought up in the bullets before is that there's going to be a lot of depreciation because computer chips become obsolete a lot faster than, let's say, a natural gas turbine.
Correct.
Now, so when you spend this much and you build up this kind of infrastructure, there's always going to be a high level of spending to just replace all of this and to keep it up to date. That means the level of spending on semiconductors, memory chips, this is all going to be higher in the future. Now, that's a good thing for the spending there, but if you think back, the last time the semiconductor sector had a revenue decline wasn't 30 years ago, it was 2022. And that, when you have this incredible market cap concentration, 15% of the S&P in it, and if people don't look at it as something that is eventually cyclical, you can have a pretty bad drop, like 2022. But I wanted to dwell on the fact that we have these charts on the page. It just really shows that information technology, innovation is the long-term outperformer. Innovation is so critical to driving equity returns. Even if at some point we want to be thinking about, okay, we need to be out of the semiconductor area tactically. You just take a look at how NASDAQ 100 has performed relative to the S&P 500. Increasingly, tech, as you see on the right, is a larger and larger percent of the economy. It's a bigger share of market cap and of earnings. We're not pessimistic on innovation in any way, but what we want to be aware of is how unsustainable the boom is. And as David just mentioned before, so memory chips are this commodity that can be in short supply. It can surge 100% for a year, next year can be down 50%. And that's all just something that we have to get used to.
That's right. So I want to conclude with this one thing before we start talking about energy and what's going on in the war in the Straits of Hormuz, which is very, very important to our thesis. Most people who have models, who actually have computer generated or backward looking asset allocation, do not appreciate the degree to which what we just talked about is going to profoundly change the actual contours of the equity market for the next 10 years. Even though chips may have a contraction, Stephen, the fact of the matter is that whether it's technology, right, and to a lesser degree healthcare, the percentage of the markets that these two will actually be will only grow for that next decade. And if your portfolios are not tilted into those growth areas, you actually will never get the total return that you deserve there. So with that said, we're now going to completely turn our minds to how is it we're going to measure what happens after the war? How will we even know that the war is over from an economic standpoint, Stephen?
So this is the thing. The last couple of days, we've heard about the one-page proposal going from the U.S. to Iran. Iran saying that it's going to consider it. Others inside Iran said, hey, we're not going to. Then this thing is going back and forth, and markets are optimistic, and they have been from the beginning, as we advise that you should be, that a blockade is not the reason to think that you're going to live with an energy shortage forever. But what we do have to see is that energy trade resumes, that the inventories that are being run down in natural gas and other critical commodities for agriculture, for semiconductors, for all of these things. They're much smaller than the volume of crude oil, but we have to see that trade restored somehow. Obviously, the economy can adapt, and everybody who said that 2022, when Russia invaded Ukraine, we'd never be the same. A lot of things happen pretty quickly here. But what we do have to see is that energy trade, which is a 10% shortage roughly in gas and oil for the world, with the help of Saudi Arabia finding other ways out, that's got to be restored. So we do need to see the Straits of Hormuz being a very likely way in which crude oil and gas comes out of the Persian Gulf and hits the world's supplies. Because other than that, we're going to see constraints on economic growth in many parts of the world.
That's right. Now, the opening of the Straits of Hormuz does not mean that the world's geopolitical structure will not be permanently altered as a result of this war, because it will be. And we heard that from Thomas Wright and from the general last week, just about the nature of those things. But on a pure economic basis, in order for us to see trade resume, to see basically the delivery of oil and derivative products, this is essential, the reopening of the Strait. So with that, next slide, if we can. So one of the things that we talked about earlier in the year was that we thought, that the forward curve for energy would actually, stay pretty constant, because it was indicating that it might have been only $6 or $7 more than it was before the war. But as the war has progressed and the shortages have developed globally, and people became more concerned about the ability for the supply chain to return to normal, not the energy supply itself, but the supply chain, we saw that futures curve actually began to look different, Stephen. And that made us change our point of view about the speed with which the recovery in prices, or their ability to reach levels closer to where they were a year ago, would actually be possible.
So, for example, we saw after the Straits of Hormuz closed in early March, the crude oil price for 1 month delivery jumped as much as $50 a barrel. It came down as much as $30 a barrel on all the hopes of a quick resolution. But beneath the surface, that dark line, that black line, is that the price for delivery at year end, and we can measure it out at almost any point, that year end price has been climbing from $6 move up to a $13 move up. Now, look, I'd be pretty happy to take the $13 and say, let's go home. But that's really the critical issue, is that if for some reason, with all of this talk about peace, we don't open the Straits of Hormuz, we're very likely to see that price for next year go up more than $13 a barrel. Now, the point of the picture on the right, now these things are not perfectly aligned, is that energy shares, they can benefit from production growth, they can benefit from the price increase, and also they get a total return from dividends. So you think about energy producers are usually better than the commodity. Now there you can see that most of the thing that it's tracked most closely is the longer term price of crude oil, not just getting an extra month of profit. And that's been boosted here. And that's one of the reasons why we're using this as a bit of an edge in portfolios now. Not just the pipelines, which we've increased our investments, but being somewhat exposed to the fact that there may be a requirement for greater production, higher profits for the energy producers. We don't view this as an optimal investment. We don't want to be overweight this investment for the longer run, but I think better be safe than sorry. When the Straits of Hormuz open, maybe we'll reconsider taking this out.
That's right. And I think, Stephen, owning MLPs and getting the total return, right, where you benefit from volumes in terms of actual increases in flow and dividend increases, right, and the build out of additional infrastructure in that same area, all of those things combined can give us a total return, and we put up this chart. I'll remind you of that, a total return that was equal to the NASDAQ, right, from January 1st of 25 until very recently. My point being is that it's important for us to recognize that diversification requires these reallocations that go beyond just the events that take place within the world. So let's take the next slide if we can. And one of the things that we want to also point out is that just as correlations, negative correlations, right, whereas crude went up, many of the global asset prices went down, we're also going to see the opposite take place, which is we're going to see for a time, not for a long period of time, but for a time, where when oil prices go down, other asset prices are going to rise. Now, we've spent a lot of time today already talking about why the fact that equity markets, right? Both, the NASDAQ, S&P, and global equity markets have actually recovered pretty sharply, even in the face of the fact the war has not resolved itself. The fact is, once energy prices actually do come down, we do expect that to provide a tailwind to markets in general. And you can see those correlations in these two charts, Stephen, right? Take a look at non-US equities versus global crude. Again, pretty dramatic, graph of that negative correlation. And again, where you take a look with treasury returns, you see that they are highly correlated with gold. So based on that, Stephen, how do you think gold will actually do once the war is resolved?
So my sense on this is that if oil is flowing again, what we're going to find is that headline inflation will come down in the US. The labor market in the United States, we got a report on Friday. Every month it's stronger or weaker than expected. Almost without exception, it's never in a pattern. The labor market in the United States has been slowing down since 2022. And we think that the Federal Reserve is ultimately going to be biased at cutting rates again. It's done most of what it has already done. A lot of the rest of the world is looking at, they've done their easing cycle, they're probably picking up. We're probably going to get declines in the US dollar again. And so that will benefit gold. The problem with gold, and we showed this on last week, is that the gains that it's had in real terms, relative inflation, have made it very difficult for gold to outperform. It's had as much as a 14% decline. It can gain again. We're going to keep some in our portfolios. The problem is, boy, this is a hedge that really worked already. I think you can see on the left picture, if you take a look at non-US shares, another thing we would say is that when you get dislocations, we want to allocate to them. We bought some. We've already moderated our non-US position because of those declines. Because this time around, the equity market decline has not been severe. So we're dealing with this particular shock. As David said earlier, we're dealing with a boom in IT. And I think you can see on the next page, you can see one versus the other on the right side. There is that chart of MLP returns versus NASDAQ. NASDAQ now is really catching up. But year to date, if you take a look at energy exporters, Cheyenne, LNG, Western midstream partners, these types of things that are providing energy to the world with record U.S. Energy exports. This is something we'll still want in the portfolio, but we're also long tech as well.
I want to spend a second just taking credit for something. We don't do that very often, but we told you a few weeks ago, right, that the disparity between aerospace and defense performance, which is the light blue line on the left, and cybersecurity, which is the black line on the left, would actually resolve, because we didn't see any reason structurally why cybersecurity companies in the world that we are about to enter into with AI would be less valuable. And now we're seeing that recovery take place, and we continue to maintain an overweight in cyber in particular. Next slide. So I wanted just to make a couple of statements. We have designed our portfolio construction to be forward-looking, which means that we are more exposed to technology, right? We are also exposed to healthcare. We're specifically exposed to software, right? And we have weightings in our portfolio, including those in our fixed income space, that reflect our best views as to where the total return and the diversification can be optimized. So, Stephen, I'm going to ask you actually to talk a little bit about where we are year to date in our performance, because our blended level 3, which is our moderate portfolio, is still keeping up with the Joneses of equity. How is that possible?
Well, it's about 6.5% year to date. That includes the fixed income side, which has had a drag on performance relative to equities. It includes non-US equities, which have outperformed a bit. But the problem is that as this energy shock has come into place, they've really lost that relative performance to the US. Now, we've been long tech, and we said all these things about, wow, I'm worried about 70% data center building growth. I don't think the semiconductor sector can grow EPS 91% every year. We're still overweight semiconductors, but this is sized to a share of the portfolio that where we think we can manage with a different set of outcomes. And we also, and our job is to be very careful in assessing every single quarter. I can tell you what last quarter happened to data center building plans, what's happening this quarter, and where it will be. We are going to be very focused with our partners on understanding when that boom is on the declining side. And we're going to have to take measures. We already have asset allocation views of what we would do with our long-term bond portfolio, with our industry sector weightings when investors hit the panic button.
That's right. So thank you so much for joining us today. We really appreciate your attendance. There is a lot going on. While we pray for the end of the war and for the return of our troops home safely, we also hope that you will take our advice and actually build more resilient portfolios, that you will look at the forward-looking strategies that we actually employ and consider them for yourselves. And for all of our friends out there, right, who are getting ready for the summer, it's on its way no matter what happens. Stephen, thank you so much for joining me today.
Thank you, David.